Good morning, everybody. It is Tuesday, February 13th, and do you know what day it is? It's the day that I get to go to a Brewer game. It is first time in 2 years almost. Brewers at the Cubs tonight. Actually, Cubs at the Brewers tonight. Although it wouldn't be out of the realm of possibility for me to drive down to Chicago. But the Cubs at the Brewers tonight. So 35% seating capacity, wear a mask, order to your seats, touchless, everything. We'll see. We'll see what it seems like. I hope this is very, very temporary. We are allowed to tailgate, which I know isn't something that everybody does, but normally in Wisconsin, you park your car and you clip it up and drink and play games for an hour or two before the game. Tonight, we're not doing that because it's cold and probably be drizzling. So as I've gotten older, I've gotten just a little bit less tolerant of the weather. So the chart I have up now doesn't have much to do with options, but I wanted to show you something. Adobe is a company that is a great company, and if we can get it at the right price, we want to. The charts and the analysis here are saying that this correction probably needed to be done. The chart agrees. The chart setup is, to me, pretty clear that it's going to come back down into this price range here. So I don't know when we get a liquidity-driven correction. I don't know when this happens, but this setup coming off of this, a liquidity-driven rally, just screams to me that it's coming back down in here. Now, this zone right in here with the multiple confluences and the key 618 line probably is where it lands, 370s. However, we never really know how bad things can get until it's happening. And if it blasts through here, not a lot of support until it gets way down here, down around 300. So I just want people to be aware of how fast these stocks can come down. So we'll look at Viacom, which is on our buy list right now. And this is something that you can write cash secured puts on. So we will look at this. You take a look at this chart and you see this huge downturn. And this occurred for a number of reasons, mainly because as streaming took hold, CBS was behind on that. And now they're catching up. And somebody was making huge bets using leverage that drove this way up. So probably this part of the rebound was very justified. And then even that was probably justified. Then this was all leverage driven. Every chart that you see that had that big run up, maybe not quite this extreme, you should be concerned that it's going to get this when the leverage comes off. And there's an awful lot of stocks out there that have leverage, had these big curves up, and people are like, oh, I made a lot of money on that. I'm pretty smart. Well, you're pretty lucky because this shape is pervasive in the market right now, which is why I've been telling people just to trim most big winners rather than writing covered calls, because you want to take more off than a covered call premium, which might get you single digits. You really want to take off a third or a half of two-thirds of a lot of these positions. So we've been focused on the cash secured put buying and the trimming. There's been a handful of covered calls that you can write, but really you want to take off more than that. And in a lot of cases, you want to take off part of your position and then still write a covered call. So, keep that in mind, that that big rally right there can turn into this. Now, Viacom is leveling off, is running into pretty big support. Could it have one more leg down to 30-ish? It certainly could. I don't think that will happen, but it could. In either case, you should be selling cash secured puts in addition to having a starter position. So if you take a look at May monthlies, you can sell $40 puts you get 267. So that's about a, what is that, about a 7 or 8% premium. Off the calculator here. Say okay, 267, 2.67 divided by 40, yeah, about 7%. And you figure that's about 6 more weeks until we get there. Not even, it's about 5 weeks. 5 weeks until we get there. So that would be 10 periods in a year. So just times 10. Oops. Yeah, 66% annualized. Let's do that again. 2.67 divided by 40. Yeah, about 10 periods in the year. So if you're selling the $40 puts to May, about 5 weeks, 52 weeks in a year. So you guesstimate that's about 10 periods in the year. Give you your annualized return. This is an annualized return of about 66% here. So I really like this. Now, that doesn't mean it can't go lower. Certainly could. And if you're concerned about that, I guess you could sell lower and take less premium. But I really like this company. I think that the selling is an anomaly. It's pulled back just about to that spot where I said, really, that's probably a good price. Doesn't mean it can't come down here. Just means that we're getting into that area where you're like, I really want to own the stock. So let's get in deeper to the plug and play focus list. If you're fundamental trends, just a little rejiggering to make this easier, right? Your 6 most recent articles are right here. Plug and play focus stocks. Also at margin of safety investing. Cash levels are still relatively high, in my opinion. If you're aggressive, 10 to 20%. If you're more moderate, 20 to 40%. If you're defensive and scared out of your wits, around half your money should be in cash. I changed the format of this because there's just a lot of linking going on. So rather than linking back and forth, just click here. Notice that I've got all the charts in here now. I still have some more to do, but uploading, still have some more charts to do. What we get in there. And I do have the charts for all of the plug and play on here. So when you go through this, I talked to you about why we want this. We've added some companies to the list. WeWork, Discovery, Enphase, OnTrack, Paycom, SolarEdge, pretty good, and Unity Software, pretty good turnover in the growth stocks. I explained why I added these. Then on the dividend collector stocks, I put on Intel. If you've seen my notes in the chats, I think that Intel, you're getting an opportunity here with NVIDIA challenging them on the server CPUs. But I think that Intel is going to largely replicate the Taiwan semiconductor model on top of their fortress balance sheet, on top of their technology, on top of their R&D. Intel is a company that the management has slowly gotten better after making mistake after mistake for years and still doing well. I think this is a stock that can go to 100, and I think that it's probably a lot sooner than you think. The whole semiconductor industry is going to start moving to the United States. And it doesn't mean that there won't be huge fabrication in Southeast Asia still, but it means that reliance on the Chinese part of the supply chain is going to change. And the United States is pumping $50 billion into making that happen quicker. Intel will be a recipient of some of that money. So between share buybacks and cash on the balance sheet and the dividend and the growth potential for semiconductors, Intel is one of the few semiconductor companies that aren't overvalued or overbought. That's why I took Analog, Broadcom, and Lam Research off the list temporarily. I'm sure they all find their way back on. Great companies. And to be able to get a dividend from a semiconductor company is awesome. But they're all expensive. So as we look through this, we want to find stocks that we can sell cash secured puts on. So what's close? We take a look at WeWork. I've discussed with you why I think this is a buy. I have a starter position already, and I think I'm probably going to sell the 1250 cash secured puts for May. I could consider going out further. I might just do that. Might even go all the way to September, collect about an 8% dividend. But I think that any of these 1250s are pretty good deals on top of a starter position. Here's why. When you take a look at WeWork, BOX right now, they have cut their expenses by about $4 billion of rents over the next several years. And their business mix, I know that how people think of it is just shared workspaces, but the reality is that over half of their business now is large enterprises. Basically big companies giving up their central locations in 1 or 2 or 3 big cities and opening smaller offices around the country. And they're using WeWork to do it. So when you take a look at who their partners are, you go, wow, this whole live almost anywhere you want to and work from home most of the time, that's really getting adopted quickly. And the technology infrastructure that WeWork puts in place and then signs 1 and 2 and 3 and 4 and 5 year leases with some of these bigger companies for limited space that can be used by their employees when they need it, is pretty interesting. So their revenue held steady for the last 3 years, which before the pandemic was bad, but now after the pandemic, you see, well, gee whiz, if the pandemic couldn't lower their revenues, that says that's a pretty strong business. And now that the pandemic has changed the world and the work from the central location is changing, WeWork's in a really good spot there. So cutting their expenses $4 billion, cutting their headcount, getting rid of their non-core businesses, they had like 7 of them. They're in a good position. They have 850 locations around the world in most big cities. Milwaukee doesn't have one, and I guess we're a small city. But I would imagine that we will have one again in the future because there are companies here that can use the space. And I think that building, at least where I am, is probably stalled. And I say this because I watch the real estate market in Milwaukee and a few other cities, Pittsburgh, several other cities. And in Milwaukee, there is a prime location in downtown. It's all ready to be built on, and nobody's buying it and building on it. $13 million parcel, and nobody wants to do it. Why? Everybody's questioning whether or not we need more space. Ultimately, I think this commercial parcel is not going to get bought for commercial. I think it's going to end up being mixed use. And it'll probably be a 30 or 40 floor tower where all the condos have a view of Lake Michigan and downtown. In any case, OX, I love this put, 1250, pick your month. If you have a starter position, I think you can go longer duration. I have a hard time going all the way to September, but I think June is pretty viable. Come back over here, Discovery. I already looked at Viacom. Discovery got beat up in that same correction when the hedge fund blew up, the family office hedge fund blew up. Oops. Again, you can take a look at where are they trading at right now? $40. Take a look at the $40 June. Get $3 for it. The May is what I sold. I think I priced it at 250 and I hit it 250. So not a lot of action here, right? Open interest is okay, but not a lot of volume. So make sure you set your limit orders. I would try to get a little bit more than the ask because the volatility is pretty substantial right now. But you can see with the shares starting to stabilize. When you take a look at a 4-hour chart, right? So when you look at it on that weekly chart, it's hard to see this, right? That's basing. This is pretty attractive right now, folks. So I would have a starter position in Discovery, and I'd be selling puts. So the $40 May or June, depending on if you want it, how you want to do this, you probably make more money in the long term by selling the shorter dated one and when it expires, selling another one. That's usually how that works out. But if you just want to know that you got a number that you got, say, $3 a share here, it's not bad. That's a 7.5% return over, say, 10 weeks, 9 weeks. Call it 10 to make the math easy. 7.5% return times 5 periods in the year, because it's 10 weeks away. Yeah, that's pretty good. That's, 37 and 38% return annualized. And that's what we're looking for. We're looking for annualized returns that are, 25%ish or higher. The thing about getting annualized returns that are much higher than that, your 60, 70, 80% annualized returns, I know it's easy to feel greedy and good about that, but usually when the volatility is that high, you better be careful. So looking for these, it came down and now it's going like that. Doesn't mean it can't go down a little bit more. This was this is the head wrapper. This is what you want to see. Oh, look at that. Consolidating, it's starting to find buyers. Look at all this volume that kicked in here. So as we go through this list, you can just find company after company after company that you can do this with. Go take a look at Spectrum Brands. Take a look at the May. Let's take a look at S. Let's take a look at this one. SPV. We were on this one a while back. Yeah, it's starting to move on us. So this is one that I told you to take a starter position in quite a while ago. Let's wait here. So this one's been running since we started talking about it a little while ago. If you don't already have a position in this, I would probably sell the put behind you and hope that it actually gets put to you. So a $90 put, either at 85 or 90. You could do either one. Depends how bad you want it, what price you want it at. Because this is definitely the top of the buy zone. It's hit the top of our preferred buy zone twice now since we've been talking about it. I do think this is headed back up here. I think you have a target price actually way up here, close to 200. And again, this is based on how the businesses change themselves, and they kick out a dividend, and that dividend's going to go up. That's just the nature of the management. And the first price target was right about here. So I really don't think you can lose with this one. Not intermediate term. I mean, again, short-term volatility can happen. But I like this one to get back to its highs, and then the breakout to a new level, again, based on what the company has done with itself. I'm going to have to make this one unpublished, I think. I'll just put it in the chat rooms. What other stocks do you really want to look at? Almost all of these are close to the buy zone. I've adjusted this list to be a lot more timely. Intel, look at the structural resistance there. And it breaks through, comes down. I don't know that it'll get down this low, but you're getting some correction in it right now. I know it's down a few bucks earlier today, but I think people are seeing what I'm seeing, which is as they get into being a competitor to Taiwan Semiconductor, which they talked about a while back and nobody believed them, but I brought it up at the time too. Now, if you compare them, Taiwan Semiconductor, say over the last 5 years, right, Taiwan Semiconductor has opened up a big gap, especially since March. But even back in here, it was doing it. I expect this gap to close. And I really don't expect Taiwan Semiconductor to come down too much, but I think they might chop for a long time as Intel closes the gap. Again, I've got 2 different sets of targets here, shorter term, longer term. So I really think you should be taking a very serious look at Intel, which is going to be hard to compete with as they get into the fab space. It'll essentially prevent anyone else from getting in there. It'll be a 2-horse race, them and Taiwan Semiconductor. And now with NVIDIA competing with them and the CPUs, don't be surprised if the chatter about AMD and Intel merging happens. Remember, Intel would have loved to have killed AMD a long time ago, but they couldn't because they were the only competitor in town. Now, I still don't know that the Justice Department will look too kindly on going back with 3 big CPU companies, which is what we now have, back down to 2. I just think that space is going to be a little bit more competitive. Think of it as like the DRAM space where there's 3 big competitors. I think that's what CPUs are going to be. But the need for server-based CPUs is going through the roof. Why? Because everything's going to the cloud. So your enterprise level buyers like Google and Amazon and Microsoft are just going to need more of those. And I wouldn't expect them to replace anything that's already there. But the new server market on the CPU side is interesting. So the choppiness brought on by a new competitor in CPUs, which is NVIDIA using the ARM products, I think is giving you an opportunity to buy Intel and sell puts on Intel ahead of them getting into the fab space. So we take a look at Intel. We'll go to 60. What does 60 look like? Get a buck. Not much. 3%. Not very sexy. June get a buck 68. So I don't know how much I'd want to tie myself to those puts at this point. But if it comes down to around here, 62-ish, just lose a few more dollars. At that point, I'd probably take a starter position and sell a put. So we're not quite there yet. I really want you to keep Intel on your radar. MGM Growth Properties. I'm loving this company, to be honest with you. No options, I don't think so. For those of you not familiar with MGM, they're buying back a bunch of shares. Their dividend yield is about 5.5%. And because Las Vegas is essentially landlocked now, there's just not a lot of development that you would expect along the strip anymore. There's only a couple spots left. And some of the space from about Sahara to just on the down south side of Stratosphere, there's a few spots there. But MGM essentially is seeing their capex come down, their expenses come down, and now and they've renegotiated a lot of things, so you have some certainty. There's a lot of upside for these properties, both Vici and MGM. And Vici, obviously, I'm pretty high on that Venetian purchase. But MGM has that cluster down by Aria that's just outstanding. So both of these companies, I think, are very worth owning, especially if you're a dividend investor. You need to take a look at these. And when we take a look at all of the REITs, what did we learn yesterday when I was talking about REITs? They really aren't long-term winners against the S&P 500. So when you find some that are, like American Tower, Steg Industrial, that's where you look. Store is at a certain level of turnaround play. Vici and MGM are new, but I really like their capital structures. And the reason why you can get a bargain on them right now is because not everybody's familiar with them. All those REIT investors are still buying these companies. It just doesn't make any sense to me, because why would you want that long-term relative bad performance against the S&P 500? Right? They had their 6-month rebound rally. That's an exit opportunity for a lot of these REITs. American Campus is one that I follow, and even it hasn't done what I wanted it to do. It's probably one that can come off of my list. But I'm familiar with where a lot of their properties are, and I think this is kind of a Biden play. So I think there's some hope for this one. All right, any other companies that you're particularly interested in? Almost all of these you can sell put on, or you could with a 5 or 10% pullback. That's how tight I've made this to the technicals. Barrick Gold, if you read your proxy statement, what do you know about Barrick Gold? They're giving $750 million back to shareholders. It's more than double what their dividend is. And it's going to be tax advantage because they're setting it up as return of capital, not a straight dividend. Because they sold properties They're just going to give their investors the money back because they don't need it. Why? Because gold prices in this new higher range, they're minting money. Newmont, the same thing. Newmont's increasing their dividend and doing buybacks. So I think that you can sell the Mays 21s, get your 83 cents. I think you can sell, I think you want to sell May because the ex-dividend date in June, I'm not sure what it is, but you can double check it. If you can make the ex-dividend date, go ahead and sell the June if you really want to. But I think that the May is probably where you want to do it. And judging by where these prices are, I'm guessing, let's find out. Ex-dividend date is May 26th. So you want to sell the May puts for this one, not the June, because you want that dividend. So I'd be piling into this one. But honestly, I just like the stock. So I wouldn't risk not owning it because this share price is going to go up quite a bit. And you take a look at their chart, switch it to daily, get a little bit better view. Look at that basing. Had that last couple steps down. Now it's building out of there. And this is right where you want to be piling into this stock. And at a minimum, it goes to around 30. But I think probably you're looking at price up here at some point. All right, any questions? Somebody's asking about Space Mobile. Yeah, I love this. I love this company's long term. I think you're just seeing it. It's getting beat up right now. As soon as the institutions start piling into this one, it's going to soak up shares fast and it's going to rebound. So I don't know that we can sell puts on this yet, can we? Yeah, not quite yet. My position in, I take that back. I do have puts on Space Mobile. They're just not showing up here. Yeah. Honestly, if you haven't really taken a position in this one yet, I'd just be selling the heck out of these $10 puts. And I had an order in here, I think at 2, so I don't know if it hit 2. There's nothing wrong with the thesis at Space Mobile. I mean, the money that they have committed to them is real. The deals they have are real. We know that it's just going to play out over a number of years. There's really nothing that can change it. It's not like they're picking rocks off the bottom of the ocean. They're putting up a 5G constellation that you can think of as towers in the sky. AT&T and Vodafone and several other big ones are in on it. So I think that Space Mobile is something that you want. I think we're basically at about as low as it can go. Fundamentally, it should be higher, but the market is punishing it. So be it. You have momentum traders pounding it right now. Take it as an opportunity. That's what you should be doing, not talking about selling it. I actually talk about the alternative energy. That's why I've added SolarEdge and Enphase to the list, because they're getting close to being buys. So you want to own them both when you get a chance, along with SunPower and maybe Sunrun, or you can just buy TAN or PBW when the time comes. I have a starter position in PBW. That last time it dipped into the 80s. Probably start selling puts on this right now. See what the May looks like. Take a look at the 80s. Yeah, you're not getting much yet. Well, it's June. Now all of a sudden it's pretty juicy there. I mean, you could sell 80s if you wanted. So let's do the math. You got 3, let's say you get 4, right? 5 by 80 is 5%. About 5 periods in the year at that duration. Right around 25%. I think you definitely could sell these for 4. Just put a limit order on it. Or if you want, bump up that limit order to 5 or 6. Right? Just play the volatility. But if you take a look where it's stopped going down already. This seems to be pretty interesting support level. Doesn't mean that it can't get down in this range. It can. Something's going to have to cause it to happen. And, if you were reading the Wall Street Journal, you saw that they called the infrastructure bill the Green New Deal in disguise. I agree with that. Now, Wall Street Journal editorial board doesn't like it because it's green. I do. I think it's a great plan. I think a stealthy Green New Deal is a great idea. 70% of the people agree with it. I don't know why it has to be stealth, but whatever. So resistance, up, down, support. Again, doesn't mean it can't come down to these areas, but this is looking like pretty interesting support to me. All right, anything else? Anybody else got a company you want to talk about? No? Okay. I really think you should be looking at this. Like I said, I gave quick thoughts on all of these essentially to help you out, give you clues of what to research, what I'm seeing. I will tell you, I've just been spending hours and hours on this because I'm finding things so fast. And I know that psychologically you get worn out, but isn't Barrick Gold just something that you love selling puts on? You get the volatility of gold built into your option premium, and now all of a sudden they say they're going to send you $750 million. It's 42 cents of essentially return of capital. Think that through. Their dividend's 9 cents a quarter, and it's going to probably go up a little bit. They're basically doubling the dividend this year through 3 special returns of capital. That's what it is. They're doing it each quarter based on 3 different asset sales that they made. And they're trying to make it tax efficient, which I think helps Canadians more. But I'm not really sure how the return of capital works for American investors. So I took Facebook off the list. Still a great company. It's rallied pretty big since Dave mentioned it. But it hasn't beaten the market all that much in recent years. I think it's something that I'd want to buy on a pullback, but I don't want it right now. And you know how I feel about Zuckerberg. I just don't like the dude. Right? So when you compare it to the S&P 500, it's not that, it doesn't beat by that much right now or lately. And again, pick your time frame. See? But now that it's rallied a little bit more since March, I want to see this come down closer to the S&P 500 and then buy it. So this area right in here, right? I really want to see it get down here. And I really think that this is where it gets interesting for me again. So again, you don't necessarily have to sell it. It's not something I'd buy right now. It's down into here. I'm thinking about it. Down here, I'm probably for sure buying it. Well, at least right around here, right? Support. Thinking about it here. Looking at how it behaves when it gets into this area. Let's call it a day. I will get this published this afternoon sometime. Take care.